The Financial Sense Friday edition with Jim Pavlava. Focusing on precious metals and mining.
Welcome to Financial Sense Weekday, and here on Fridays we always look at the issue of gold. On Wednesday, Federal Reserve Chairman Ben Bernanke had his first ever, of a Fed chairman by the way, press conference at which he said,
"On the inflation front, commodity prices have risen significantly recently, reflecting geopolitical developments and robust global demand, among other factors. Increases in commodity prices are in turn boosting overall consumer inflation. However, measures of underlying inflation, though having increased modestly in recent months, remain subdued, and longer-term inflation expectations have remained stable. Consequently, the committee expects the effects on inflation of higher commodity prices to be transitory. As the increases in commodity prices moderate, inflation should decline toward its underlying level."
But gold popped up Wednesday after the announcement was made that the Fed would keep the interest rates near zero, stoking some fears of a weaker dollar and inflation. What's really out there right now is the anxious nervousness you keep hearing from some of the mainline crowd that, well, you know, gold and silver, they're in a bubble right now, and that bubble's just got to burst, and it's going to go down catastrophically when it does, so beware. Nick Barish just joining me. Nick, I guess two things to talk about as we're starting out. First of all, the impact of Ben Bernanke's speech, and second of all, is this really a bubble? Because I think you said before we got on the air, the dollar keeps tanking and gold keeps going up.
Well, that's right. I think the people that think gold's in a bubble think that it's, an industrial commodity like copper. Today copper went down. And that's the main difference is that, gold's been money for 3,000 years, still is today. It's traded on the currency desks of all the banks and brokerage houses, not the commodity desks. And they trade it against currencies. And until people understand that that's what it is, they won't really understand what's happening or why it's rising. And simply what's happening is that the currencies are declining because they're creating too much of them and people are losing confidence in the currencies. And the U.S. dollar is in the lead on that, but it goes across the board, basically to all currencies.
And the same could be said for silver, although it has some industrial uses per se, it's still perceived as a certain form of money as well.
Well, that's right. Silver, has the same long history as gold does. It was considered poor man's gold, where gold was used as money by, kings and emperors. Silver was used by the people. And platinum is the other third metal that is traded on the currency desk, gold, silver, and platinum. And platinum was used in Russia for 300 years.
So what do you think this anticipation, the psychology of the market, is going to lead us?
Well, I think the first thing is that a lot of people think of trading gold like a commodity, and everybody was thinking it was overpriced in silver, and, we had the pullbacks in the last couple of days. But that's an extremely dangerous thing to do with your precious metals holdings. If you want to trade the market, then hold on to your bullion and buy puts and calls if you think you can time it accurately. But the last couple of days shows you would have been mistaken to have sold your silver because you thought it topped, a couple of days ago, and now it's starting to go down. They both reversed totally.
Yeah, that's if you buy into the idea that we're in a bubble and that sometime it's going to burst and we have to time it to get out. What about corrections? Foreseeable?
Those are a normal part of it, and the thing we don't know right now in silver, because it has had a tremendous increase, and what we don't know is what exactly is the cause of the increase. If we're going through a short covering rally of major proportions, then we could have a serious pullback when the short covering is over, but that could take a long time because of the size of the short positions. So that's the areas that we don't know, and it's we've studied this a long time, and we haven't found any successful trading method. So the thing that people should do is just accumulate physical bullion, and if they think they're smart enough, they can trade puts and calls, on what they think the ups and downs are. But if you try and trade the bullion, most of the time you'll be buying back in at a higher price.
Well, if we look at the future prices of gold in terms of what people are always asking, how high it could possibly go, we're coming up into a situation here in June where theoretically QE2 comes to an end, but at the very same time there seems to be this eroding confidence in the dollar. I don't see that as stopping at any time in the future, despite the talk coming out of the Federal Reserve. So what does that mean for future prices of gold?
Well, the question is, like, the Fed is buying 70% of the T-bills, and there's little in the way of other market participants. So, like, somebody explain how they're going to stop. If nobody else is buying the T-bills, how's the U.S. going to fund its $1.7 trillion deficit? I can't see that. As they have to print more money because the buyers have opted out, then, gold's going to keep going up, and I don't see that they're going to have any other choice but to do that.
They are out of options right now. It's like going down a narrow box canyon. The walls get closer and closer on either side until finally you don't have much of an option left but to keep plying the same route. So if you know that, then you can assume that gold is going up.
And that's what people ask me. I really say you need to reverse the question, is how far can they debase the dollar, which is, more or less infinity, just like any other fiat currency and any other hyperinflation. The numbers become ridiculous.
From the point of view of investing, what's the most important strategy we could be following right now?
Well, I think the important thing for people is they need to be accumulating their bullion positions and just do it on a dollar cost averaging, because to try and time the swings and so on, in the long run it won't matter. I gave a speech at the Empire Club in 2005 when gold was about $400 an ounce, and I said, to project whether it's going to be, $430 or $450 this year is irrelevant, because in the long run it won't matter. And now when you look back and gold's at $1,500, it wouldn't have mattered whether you bought in at $400, $450, or $500 in 2005.
Right, because the increase was rather substantial over that. So if you buy in now, you're still going to make a climb out somewhere down the road that you could still do on that.
And that'll only stop, like I say, when the current monetary policies around the world by the various central banks will stop doing what they're doing. But the only thing is, I can't see that they will be able to do that anywhere.
Do you suppose that there is any kind of market manipulation going on right now? Kitco ran an article on that by Richard Zimmerman, the Bullion Report, Market Manipulators. Those roles are running around on the street as well.
Well, I guess, we'll never know if it is on the one side. But secondly, there's a difference to me between market manipulation and opportunism. So if we look back at the leasing, was that market manipulation, or the fact that you can borrow gold at a half a point, sell it, and buy T-bills at 5 point, just opportunism? If you could do that, why wouldn't you?
I wouldn't categorize that as being manipulation. That's somebody just taking an opportunity, like you say, rather than trying to affect the price of gold or silver out there in the market.
Well, part of the difficulty is to affect the price of gold now that it's becoming a global phenomenon is going to be extremely difficult. In the 70s bull market, that was largely a North American phenomenon, with mining stocks generally outperforming gold and so on. Now we have a different phenomenon. Mining stocks, except some of the really good juniors, aren't outperforming bullion. And that's because it's a global market, and you've got the Chinese, the Indians, the Russians, the Brazils. And when they get, nervous about the currency and the economy, they don't run out and buy shares of Barrick, run out and buy physical bullion and take it home off the market.
Right, because that's something you have in your paw.
Right.
As opposed to a promise to somebody to pay you something in the future or to give you a transfer of ownership somewhere down the line.
That's right. So that's where you have this different supply-demand dynamics in bullion, because it is a global market, and as a result, it's also very hard to manipulate. If you manipulate it downward, you're just giving the rest of the world a gift to buy it at lower prices, and you're back up to the same point.
How do you think silver is going to track with gold? If we assume that inflation is going to continue on upwards, will it perform better than gold now as we go forward?
It looks like there's still a lot to catch up. When you look at gold and platinum, they both surpassed their 1980 nominal highs, and silver hasn't quite hit there yet. So that's number one. Now, there's no magic in ratios, but there is a couple of things to consider. One is that the ratio of gold to silver in the ground is 16 to 1. Under the U.S. Coinage Act, I think 1800 or 1792, they defined, a dollar as being an ounce of gold or 16 ounces of silver. And the ratio in 1970 was 17 to 1. And we're at 33 to 1. And based on the fact of how much higher gold is relative to its 1980 high, silver should be $100 right now.
But it's not, so there's some catch-up room going on there.
Catch-up to do. And part of that is that we've had such a decline in silver prices through the 90s because just the U.S. alone divested itself of 2 billion ounces, 1 billion at the mint and 1 billion in strategic reserves. So what you had is the silver price became over-depressed and the price too low, and it's still in catch-up mode from dumping all that silver onto the market. Now there is very little above ground silver.
Do you find that silver prices reflect inflation pressures as much as gold does?
Well, the funny thing, David Ranson of Wainwright, studied that, and he found surprisingly that platinum is the most leading indicator of future inflation.
Why so?
We don't know, but
it just does it, right?
That's what it was. If you take gold, silver, and platinum, all three are the most leading indicators of any of the other commodities of coming inflation, and the gap can be as high as a year.
I never knew that about platinum.
Yeah, it surprised me as well.
So that's where the situation is, where we stand right now. Probably another leg up, what we're looking for in the metals, and we sit and watch, I guess, right?
We may have a correction come the summer if we go along with the previous seasonal trends that have usually been a dip in the summer, but that would simply be an opportunity to keep dollar cost averaging in until you get the appropriate amount of holdings.
Nick Barishev, website, any closing thoughts?
Our website is bmgbullion.com, and like I was saying earlier, I think that the strategy for people is accumulate their bullion holdings, and if they want to trade, then puts or calls on dips and the rises. And that way they don't risk their bullion holdings getting whipsawed.
The bullion holdings are assurance and a little more peace of mind than return is going on out there.
Also, there's so many instances where the technicals don't work and people think they can trade the technicals. The best example of that, there was a lot of talk about selling bullion when it was going down, and then an announcement made that India bought 200 tons.
Right.
And it completely reversed where all the technicals were telling you to sell.
Right.
And you would have got whipsawed so fast, you would have been buying in at a higher price.
Remember, technicals are an analysis of what went before in trying to forecast the future, and rogue events change that and throw it off balance. Yep.
And it's also that bullion is a relatively small market to the financial market, and it's the same thing as technicals don't work on junior mining stocks because one guy spending $100,000 throws the technicals out the window either way. So it's the same kind of thing.
Nick Barishev, I appreciate it.
Okay, my pleasure, John.